All right, let's have a look at heavy retail involvement. So knowing that there's a lot of large retail involvement or large retail holding is super useful. If you go back to the analogy that we had for social media, and let's look at this. So there's kind of, and we have to generalize in some way. So we're generalizing in this way. We're saying, okay, capital, they're often undercapitalized. Retail traders generally undercapitalized compared to institutions. Time frame, most retail traders are looking for a quick and a large win. So they're in things that they'll give them a quick and large win. Now let's just kind of put the distinction here between professional retail, or people who are trading retail but trading it in a professional manner, perhaps not trading it professionally but in a professional manner, and retail gamblers. There's a lot of retail gamblers out there. So this is the retail gambling crowd. They're often looking for a quick and large win. Pain tolerance, they often are super over leveraged, so they can't withstand much drawdown. Emotionally, they're attaching way too much emotion to individual trades. They've got an ego, they need to be right. The odds of success, we know that stats show that retail is very poor at trading from a short-term basis. So the odds of success already are stacked against them. So if we're trying to fade retail, we've got a good chance of success. Decision making, the point here is that it's easier to predict the decision making process of the retail trader than it is any other trader. And why is that? Well, if we go back to that analogy of a stock that's come out and it's got some great news, the retail trader will deploy all their capital into that stock, wanting to make a quick and large win. They'll see this thing going up, they think it's going to double on them, they think it can turn their double their money overnight, and so they'll push their money and then maybe they'll be margined up. And because there's all their capital, because they're looking for such a big win, because they don't really have much mismanagement, because they kind of tend to be on the side of a gambler, then they will be very sensitive to pain. In other words, because they're leveraged and they've got all their money in there, any slight pullback hurts a lot. Whereas institutions can stomach massively large pullbacks because ultimately, that's their business, right? They're not in there for short. I don't know, some institutions and hedge funds do short-term trading, but generally speaking, they're investing for a longer period of time. They don't care about drawdown, whereas retail's very sensitive, especially this type of retail trader. And again, they're emotionally involved in it. They've got a lot of their money on the line. They tend to be quite ego-driven. They're like trying to get the wins. They're looking for the win and the thrill of the win and the big gain, rather than the kind of consistency there. And as we know, the odds of success are low. So in that stock that's ripping up, they're buying it. They're buying it with a fully loaded boat, i.e. they're margined up. And if it's a stock that is generally only traded by retail, i.e. a small stock, you haven't got institutional involvement, you've just got pure retail in it, you're going to get a supply demand shifting massively into demand. Bang, 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 bang. As all these guys pile in, they'll get excited. But knowing that that is the only thing that is causing the demand, and knowing what their vulnerabilities are, the pain tolerance, the time frame they expect it, the emotion, the odds of success, the undercapitalization, knowing those things means that when we see drawdown and no further push to highs, we can have a feeling that, hey, we know demand has come from them. There's no more demand going to come in. There's not much demand going to come in from elsewhere. Institutions aren't bothered. We're out of the question anyway. We picked our stock based on that. They're not going to supply any more demand, and they're actually going to flip to supply. They're not going to give any more demand. Let's not confuse ourselves. They're not going to give any more demand. They're actually going to flip to supply. So we're going to have that weighting that's bang, bang, bang in demand. All of a sudden, that's going to jump from that end of the seesaw to the other. Doosh, it's going to shift in a massive direction the other way, because those guys are going to pummel it because they want to get out, because they're very sensitive. They're under massive loss. They're emotional. All the kind of things that we just talked about. And it helps us get a read. So it helps us to know if there's a large retail holding. It helps us to know who's holding the other side of the trade. And it goes back to the initial thinking, guys, with a price action trader is, who's the other side of the deal? Who's going to sell it after I've sold it? You've answered your question here. If you're going short on that stock, you know going short because you think there's a large retail involvement who got sucked in with the morning drive on the news. They're all excited. You've got an idea of the type of person they are. And you think, and you assume, and you hypothesize that they're the guys that are going to dump the stock after you sold it, causing it to completely collapse and you to make a nice big profit on your short. So thinking about trading stuff that's got a high retail involvement, and who's on the other side of the deal. Again, we're always thinking about this is a very specific example, but again, always thinking who's on the other side of the deal, what's their motivation, what are they trying to achieve, where are they going with it. Gaming theory, chess, that's price action trading.